Good morning, everybody. This is the live market open for January 28th. Sorry, oops, made a mistake here. It's already 29th. It's Friday, and we had a very, very busy day yesterday, the 28th. And today also began with the storm. I'm Yohay Elam, Forex and Market Movers podcast, doing the show as usual for FX Trade. I hope you can all see the video. I heard some questions here, saw some in the chat. So we just began, and let's see what we'll cover. Well, of course, recent developments, or quite a lot, charts and levels, the next 24 hours, and your questions. Next 24 hours means next trading day or so, and we'll also have a preview for next week's events. Like every Friday, I'll just note now and also at the end that on Monday we will not have a show, but today we'll have a full show with the preview for next week, and we'll be back on Tuesday. So let's begin. I don't know where to begin. Let's start with the most recent event. Hope you can all see the screen. Anyway, the most recent event is the Bank of Japan. They really did it. They acted. They went negative. They announced negative deposit rates, a three-tier system, a bit more complicated perhaps than in Europe, but it's the first time that they set negative interest rates on excess reserves parked with the BOJ, very similar to the negative deposit rates of the ECB. Okay, so let's look at dollar yen first and foremost. Yeah, if you load the page, yeah, negative rates in Japan indeed. Look what happened. Look how we traded. Well, we're back to levels last seen. Well, not that long ago, but back in December. Since then, we had this fall. We had dollar yen reach 116. When we reached 116, we heard the Bank of Japan telling us that they're watching closely currency movements, and Prime Minister Abe said that it's time for the Bank of Japan to act. Now, it wasn't that easy. First of all, we had this rise back here. When we had the announcement, first of all, we had some kind of noise, some kind of leak from, I think it was the Nikkei agency. Anyway, talk about negative rates, and we had the initial spike and then the fall. But eventually the news did come out, and we have a negative interest rate. Now, we had a 300 pip jump all the way up to 121.40, more or less. Yeah, 121.39. Since then, we've stabilized in range, but the range is above 120, okay? So currently 120.70. Previous line I have here is 121.10. I don't think it's relevant anymore. I think that 121.50 is more relevant. And let's put 120 here at the bottom as the round number at the bottom. Okay? Yeah, indeed, these are currency wars. Japan doesn't like the safe haven flows to its currency, to the yen. The yen strengthened against the dollar and also against the euro a bit, and of course much more against commodity currencies. And because the Chinese yuan weakened against the US dollar, the Japanese yen strengthened also against it. Anyway, now we have a retaliation from the Bank of Japan. We're back to 120, almost 70, and this also is reflected on other crosses. Let's take a quick look here. 131.50 on euro yen, also back to the level seen before the Draghi drag. Okay, before Draghi disappointed. So we're back all the way up. Okay, yesterday we've seen some kind of small move up because, well, the euro was strengthening, but now we have a full effect. I see resistance only at 133.15. We're back to the old lines. Pound yen, just said yesterday how exciting it is, so it became even more exciting. Currently 173.57, already crossed the 174 line. I see resistance at 175, support at 172. We bottomed out here. Perhaps if you want to see this bowl shape or U-shape kind of reversal in pound yen, one of the more fascinating pairs. But remember that with any high moving pair, there is profit and also risk. Let's look again at dollar yen and tell you a few more things about the decision. First of all, it was not a unanimous decision, okay? And we have the voting pattern, and it was 5-4. So government Kuroda was the tipping point between acting and not acting. Okay, it was a very, very tight call. There are 9 members on the Bank of Japan in Tokyo. 4 out of 9 voted against this move. Okay, so it was a very, very close call with no consensus. They did agree to maintain their current QQE rate of to reach a monetary base of 80 trillion yen. They didn't change this. On this one, there was a consensus. They also, and why did they act? Of course, because they had to push back their inflation target once again. So it's in the second half of the next fiscal year. The fiscal year in Japan begins in October. So it's in the second half of 2016, 2017, which means somewhere in the spring, summer of next year, they'll reach the 2% target. It's not the first time they're pushing it back. Also, the ECB is pushing it back. Also, the Bank of England is pushing it back. Also, the Fed is frustrated with inflation. So it's a global phenomenon, and so are currency wars. More figures, more stuff we had from Japan is that the official inflation figures from the government disappointed, and but the Bank of Japan's new measure of inflation is actually up 1.3 year over year, and the core price is a very selective pick of items, I believe, for inflation to make them look a bit better. Okay, it was a big move this morning, and it has ripple effects. Well, it's seen also in other yen pairs and elsewhere. Sinatra woke up earlier than usual. Yeah, the yen must have steered me up. Currently trading a small long in dollar yen. Yeah, perhaps we could see more rises on this pair because it was quite a big move, and perhaps markets haven't fully digested it. Okay. So let's talk about other pairs. We had lots of movements yesterday. First, let's get back a bit to the event, perhaps, that we had yesterday. Okay, so let's begin from the top, because it's also relevant for today. German inflation came out as expected. I think it was 0.4 on the HACP year over year. All the figures, I think apart from one, came out as expected. Slightly higher inflation, but that's only because of the removal of base effects. Okay, so last year we had the big fall in oil prices coming in November 2014, and then it was really felt in January when more or less prices reached the bottom. Now, we're 1 year afterwards, we have the preliminary figures for January 2016. So the year over year, okay, shows a smaller effect. Yes, oil prices fell a bit more, or a lot more, but in relative terms, they didn't make this big fall from around $100 to $45. They just fell from 45 to around 30. So this is the main reason for a rise in German inflation. We'll see it today also in Eurozone inflation, a small rise. Okay, talk about that soon. That didn't really move the euro. What did move the euro is initially we had terrible figures from the United States of America. Durable goods orders, they fell, they crashed 5.1%, the headline figure, and also the core figure, excluding transportation, which is very volatile, Boeing aircraft and things like that. We also had a terrible fall of 1.2%. It's a figure for December. It feeds into the GDP that we have today. The core figure reflects investment, okay, so it doesn't look good. So that sort of weakened the dollar across the board. Euro enjoyed it, but it also moved because of oil. We'll explain and talk about that soon. So we had a move up in the euro. As I see it, euro dollar remains a frustrating pair. It remains in range, but what we can see here is that it trades in a narrowing range. Okay, you can see here one high at January 15th, another lower high on January, well, that's 20th. And yesterday, another lower high that was January 28th, okay? So if you focus only on technical numbers, you can see lower highs, but you can also see higher lows. So it's a narrowing range, some kind of trend here. I see the range is very narrow, very frustrating. Currently, we're back to the drawing board. And what also happened yesterday that moved the Canadian dollar, and of course, and also had a side effect on the euro. That was a crazy move in oil. Okay, sorry. That's what happens when I talk too fast. So how did the Bank of Japan move euro dollar? Well, we're currently seeing some weakening of the euro, but it's not only because of the Bank of Japan. Yesterday we had a move in the euro because of oil prices and because of durable goods orders in the United States. So we had oil prices trading at around 32, already above the lows. And then we had some rumors, news coming around oil prices. Okay, what did we have over there? We had talk. Remember, oil, it's about 100 million barrels per day, or 90-something thousand. A third of this is OPEC. OPEC, if it decides to cut production, it's only Saudi Arabia, only a third of OPEC, only around 10, 11 million barrels a day. Everybody wants Saudi Arabia to cut. In order for prices to really fall, we need not only Saudi Arabia to cut, we need either other OPEC members or we need members outside OPEC, like Russia. So yesterday we heard some news that Russia and Saudi Arabia are considering cutting production by 5%. Now, if these two big producers cut by 5%, that's already significant. But they also want others to cut by 5%. And then you have troubles because, first of all, the US shale industry is never going to cooperate with them. Of course, if someone else cuts, they'll just have more profit. And the same goes for Iran. Iran is starving for money, just came back from, just got off the sanctions. It wants to sell oil, and the oil production in Iran is quite cheap. So what did we have in oil prices yesterday? We had a roller coaster all the way, almost 10% from the lows, up to nearly $35. It's an opportunity to thank Dale Pinkert. I was with him on the show on Wednesday covering the FOMC, and he said he could see a short squeeze to 35. You know, when everybody's short, nobody's left to sell. Anyway, we had these various reports, news reports. It sent oil prices to 34.80. But then when we had Iran saying, we're not in, and we had more details showing us it's complicated to have any kind of agreement between everybody in OPEC and outside OPEC, we had a crash back in oil prices down to 33. When oil prices fall, it's more of a risk-off environment, and that also fueled another small push up in the euro. Okay, so the euro dollar is moving a bit more marginally. Okay, first weak US figures, it's doom and gloom for the world. It pushed the safe haven euro a bit higher, and of course the dollar lower, and then a bit more on oil prices. But since then we had a reversal. We had weak figures in Europe. We had a bitter mood. I think that what's happening now, to answer your question, Fabian, perhaps the move down in the euro is in tandem with the yen. Both are safe haven currencies, so we might see the euro weakening alongside the yen as the market mood improves. Oil prices this morning are higher. Oil is a risk asset, so higher oil means higher commodity prices, higher commodity currencies, higher pound, and weaker euro, weaker yen. These things are all correlated, and the euro has its own reasons to fall. We also had this morning sorry, I have here the wrong data. We have German retail sales disappointing, coming out worse than expected. Let's look at the calendar. Okay, this is the FX Street calendar on Forex Crunch. Yeah, so retail sales in Germany came out 1.5 year-over-year, worse than 2% expected, and month over month in December they actually fell. So Christmas shopping was not that strong in Germany. That also has some kind of, I wouldn't say too much because it's a mixed bag there, but it's also some kind of disappointment. Now, I talked about oil, and of course, when we talk about oil, we talk about the Canadian dollar. Look what happened here. Canadian dollar, boom, it fell. Dollar CAD, that means fell all the way to 139.47 yesterday, and then rose back up, exact hand in hand with the movements in oil. Rumors about cutting production, higher oil prices, higher Canadian dollar, fell, crashed under 140. Iran denied, other details emerged, boom, dollar CAD went back up. Now, with the rise in oil prices this morning, dollar CAD is again taking 140 for another battle, and currently we're at 139.86. All in all, there's downside pressure on dollar CAD because we have an improvement in oil prices. Okay, we already reached a low of 27.50, and now we're at much higher levels. You can even say it's a bull market in oil in comparison. Well, in the if we look at the past week or so, if we look at, of course, the bigger scheme of things, oil prices are down. Okay, a few questions here. I'm long. Jax is long. Aussie yen. Aussie yen. Well, good choice because Aussie is a risk currency. Actually, news coming out of Australia tonight wasn't so good, but it wasn't also terrible. The bigger news we had from Australia this week is that CPI rose more than expected. So if we look at the Aussie against the yen, we can see that it's up. I'll just find it right here. Wow, that's quite a move. Good for you. 86, over 2% higher. Stronger Australian dollar on stronger commodity prices, better market mood, and the weaker yen on the big action from the BOJ. Okay, I see resistance over there at 86.50. We're close to that level, and support, I would say it's probably right here at 84.80 with further support at 83. Okay, so if we're looking at Aussie against the yen, and on the top side, well, next resistance 88. Okay, another comment here. Given the bad data from the United States yesterday, anyway, they give hints of a negative US GDP, or is there no relation? Of course, there's a very good relation, okay? Because the very big, significant relationship between what we had yesterday, the weak figure, the core durables goods orders, which was for December, and the read for GDP for this quarter, for the same quarter, for Q4. Okay, I don't think we'll have negative number because the Fed said that we're seeing weak growth. So I still expect a positive number today, just because of what the Fed said. But this terrible durables goods orders doesn't look good. At least we had jobless claims coming out as expected, but we had another disappointing for pending home sales. The big report yesterday was a miss on durables goods orders, not a miss, a crash, a disappointment, terrible number. Dollar yen leading to 125 and pound yen to 175.80. Not so fast. Well, on pound yen, it's much closer, and it's certainly possible. But on dollar yen, 125 is a long shot. We'll need a positive surprise, a huge positive surprise today from GDP, and they don't expect that to push dollar yen higher. We should have, we could have the rolling effect of what the Bank of Japan did eventually lead to 125, but it'll take some time. Okay, let's talk about a few other currency pairs before we talk about events for today. The pound, risk asset, moving a bit higher, struggling with this line of this double top here, which was double top. Now it's a battle line, 143.64. We already crossed the 144 level this morning. Let's do some adjustments to technical lines. Too many lines on the charts. Another line we have here. I would say that the next line of resistance is 144.75 on pound dollar. Support at 142.40, followed by 141.25. Yesterday, UK GDP came out as expected. Thanks, Sinatra. Here's your crude bull market. I see it in upward channel. Let's look at the chart quickly. Yeah, we can see the channel. I'll share with everybody, those of you not in the chat. Okay, this is a chart courtesy of Sinatra. So yeah, we see an upward channel in oil, right? Thank you. Other currency pairs, we talked about CAD. Aussie dollar, we talked about trading Aussie yen. So also Aussie dollar. No bad news from China. No bad news is good news. No news is good news from China. Next level 71.50 to watch. We already reached 71.40 on Aussie dollar. The better than expected Australian CPI this week was certainly positive for the Aussie. 70.50, I still see it as support, but it's not as strong as it used to be, followed by 70. Higher resistance 72.20 and 72.80. We're getting back to the old levels. Next week we have the RBA, and they're not expected to act. Kiwi dollar. The Kiwi was hit hard by the Bank of New Zealand because they said they're ready to cut rates later this year. But since then, we had a nice recovery. So we're back to 65.20. This fall seen here was very sharp, but we found support at 64.17 or 64.15 if you wish. And since then, we had a nice recovery together with other commodities, even though milk prices don't look so good, even though inflation in New Zealand doesn't look good. The Kiwi got carried away. Next resistance, 65.80. Ever chart the yuan? No, because it's the yuan is moving according to what the Chinese government tells it. It's not really tradable currency, so I don't like it too much. Okay, let's talk about other currencies. Dollar Swiss, 101.77. We already reached. Oh, that was a nice move. I didn't see that. 102.22 was the new high, about where we put resistance. What happened over there? I suspect it's related to the Bank of Japan, that maybe we had some flows, sell-off also of another safe haven or some kind of intervention by the Swiss authorities. Let's look at Euro Swiss. Same move here. Quite a weird spike to the upside. On Euro Swiss, we reached 111.32. I have to check what's going on with that. Anyway, we're back to previous levels. Look how Euro Swiss is moving in nice ranges. Trades in range, moves up. Trades in range, moves up. Trades in range, moves up. Now again in another range. But don't mistake that for good technical behavior. It's just the Swiss National Bank playing with us, intervening to weaken the franc. Okay. Euro pound falling in range, sort of established itself at between 75.45 and 76.50. I have quite a few figures today. We'll talk about that soon. Euro yen we talked about. Pound yen, okay, and oil a bit getting off the boil. Okay. Let's talk a bit about events for today. Yes, US GDP is the main figure. So just to answer your question quickly, the expectation for US GDP, the most important figure here among all these figures is, well, there are just two, sorry. Oh no, there are a few more releases at the same time, but the one to watch is the quarterly annualized, okay? So basically in the United States, contrary to other countries, we look at the annual level, annualized level of GDP. So it's expected to rise 0.8%, weaker than the final figure of 2% in Q4. Okay, that means very weak growth. If you compare it to how they publish figures, GDP figures in the United Kingdom, it's actually something like 0.2. Okay, because the annualized figure means they basically multiplied by 4. So it's only 0.2 quarterly growth. Yeah, together with that, we have prices. We have the employment cost index, which is also of some importance. It's expected to rise 0.6 because that's another measure, wider measure of wages, of inflation, wages, inflation and wages. Goods trade balance, sort of the preliminary trade balance figure, but everything is sort of secondary. Well, also the core personal consumption expenditures, the core PC on the quarterly level. These are also interesting figures to watch. I would say that the most important one for the immediate reaction is GDP, expected to rise 0.8. And the secondary one, I mean, after things calm down a bit, we have to look at the composition of GDP, okay? Because when we have growth, it depends on where it comes from, okay? If it comes from investment, it's good, okay? If it comes from consumption, I don't think it's really that good, but it's also good. It means that consumers are buying more and they have more money in their pockets, and inflation is eventually going to rise. Okay, the bad sources of growth come from government, especially when it's defense spending, because that's not really productive. And worse than that is inventories. Okay, when we have inventories rising in one quarter, that means they'll be replenished in the next. That means they'll be depleted in the next quarter. Okay, so when we have, for instance, strong growth, but a lot of that is inventories, it's actually not so good. When we have weak growth, but that's because of depletion of inventories, that's not so bad, because we know that in the next quarter we'll have them building up once again. Okay, so it's also something to watch. Remember, it's the first release out of 3. It'll change, and GDP revisions in the United States are quite significant, contrary to the UK, contrary to Europe, where we almost never have any revision. So also something to watch out for. I think it'll be closer to 0 than 0.8, and it could be worse because of the durables goods orders, because the Fed told us that growth is slow, and well, we have to look then about the composition, and perhaps the other figures will have a minimal impact as well. Yeah, I'm prejudiced against the franc. I don't like their intervention. I don't think you can trade it freely, safely. Okay. Anyway, what else do we have today? We just had Spanish CPI and Spanish GDP. The 4th largest economy in the Eurozone doesn't have a big impact on the euro, but still worth watching. Okay, so first of all, inflation in Spain is worse than expected, a drop of 0.4% year over year. So in Germany, it came out as expected, but in Spain, the 4th largest economy, it disappointed. And that's, of course, feeds into the into the preliminary Eurozone figures, which we have at 10 GMT, which are very important for the euro. We'll talk about that more in detail. We also had GDP from Spain, exactly as expected, 0.8. But remember, when GDP is based on falling prices, that means real GDP is 0.8, but nominal GDP is a bit weaker. Anyway, living here in Spain, many people are not really buying the story of the stronger economy. Annual GDP is looking really good, is 3.5% stronger than other countries, but remember, it's also based on falling prices. Okay, so these are figures we had from Spain this morning. We also had figures from France, came out exactly as expected. Consumer spending, and well, sorry, not exactly, a bit better. French version of retail sales, consumer spending 0.7 was the actual figure. It's for December, it's a bit old. The figures from Spain are for now, for CPI for January, and well, GDP for Q4. Then we have at 9 GMT, just after the show, we have monetary data from the ECB. Okay, so we have private loans, they're expected. No, we don't have expectations. That's what the ECB focuses on. They want more people and businesses to take loans, and they want more money in circulation. So it was already negative during 2012, 2013, 2014, and they did manage to push it higher. So it's easier to take loans, so more loans are taken. So the pace, so we now have positive growth in loans. M3 money supply, money in circulation, the same trend, it has accelerated. Okay, but the main dish for today in Europe is inflation figures. They're preliminary, so thus more important than the final figures. and they're expected to show some relief for the central bank in Europe, for the ECB. Headline inflation is expected to rise from 0.2 to 0.4. There is a small chance that because of the weak figures in Spain, we'll have it slightly weaker, and this could impact negatively on the euro, because it's not because of safe haven flows, because this means that the ECB has a higher chance to act. Okay, the ECB's mandate is headline inflation. Now we also have the core inflation figure, which many are hanging onto. You can say that headline inflation is down because of oil prices, but when we talk about core inflation, it's supposed to exclude oil prices. And here, well, we don't have a consensus, but I'm expecting another 0.9. If we have another fall, it'll be negative. What Draghi said is that recently the strengthening in core inflation is weakening, or in easier words, he's disappointed that inflation is not going up, that he's failing on his mandate. Okay, so I think that's a very important release for the Eurozone. At 10 GMT, the inflation data, more important than monetary data and what we had from Spain. At 1:30, GDP, we talked about that. And we have Canadian GDP at 1:30 as well. For those of you trading the loonie, why don't I have it here? Let me check if my filters are wrong here. Calendar provides lots of data, but you have to decide to look at it. Yeah, so in Canada, contrary to many other countries, they publish GDP on a monthly basis. So this is the figure for November, the middle of Q4. The expectations are for 0.3. All in all, the Canadian dollar moves just a bit on domestic figures on GDP, employment, and even the Bank of Canada has sort of a limited impact, and oil have the biggest impact. Okay. Yeah, the same we talked about. Goods trades balance in the United States, probably overshadowed by GDP and its components. And 3 GMT, it's the final consumer sentiment by the University of Michigan. It's expected, more or less, to confirm the previous figure. A small fall from 93.3 to 93, not as important as GDP. Let's just talk a bit more about GDP. GDP could rise in its importance as NFP falls. Okay, we know that the employment situation is good in the United States. We know that wages are moving slowly. The big question is, will the Fed raise rates, and is the economy improving and jobs will continue rising and everything looks good because of employment? We'll eventually see wages and inflation rising, or is employment a lagging indicator? And the leading indicator in this case would be GDP. So if we have weak GDP growth, okay, and we'll learn about this today, eventually less growth or even a danger of a recession, at least in the manufacturing sector, doesn't look good. Eventually, when we have less growth, we will have jobs lost or a very significant slowdown in job growth, okay? So I think GDP today is of high importance. The first revision of GDP at the end of February is of high importance, and the final GDP in March also. But the next GDP release in February will be the one before the next Fed meeting. So I think it'll be important. Okay, so that's really a big event for today. About currency reaction, if we have a terrible disaster GDP, that means a negative number. It will be bad, of course, for the US dollar, but worse for the dollar against the euro. Because we just heard from the Bank of Japan, so the yen is sort of looking for its new safe haven role. It still remains a strong safe haven, but today perhaps on the back burner, and the euro is a stronger one. And if we have a really terrible GDP, it's not necessarily good for commodity prices, okay? Because on one hand, okay, the Fed is not going to hike more free money for everybody for commodity currencies for the pound. But on the other hand, it shows that the US economy cannot lead the world forward. Less growth for everybody, depression, and things like that, okay? So, and if, of course, we have a positive GDP, it implies a rate hike, and that's good for the dollar, especially against commodity currencies. but less so against the euro and the yen. Question here, is there a site or an app or tool that shows you the strength of the economy that takes all recent fundamental analysis into account? Not that I know of. There are, of course, lots of analysis pieces on the web. You can see momentum as sort of if we have an acceleration of growth that shows the strength of an economy. But I mean, the trend, okay? But I don't know. For instance, Japan, we have weak inflation, the yen falling today because of what the Bank of Japan did, and in general, frustrating growth for 2 decades. But is it bad to live in Japan? Not at all. The unemployment rate is 3.3. Highly developed country. People there have a excellent level, excellent quality of life. And I don't know, emerging markets, things, I don't know, India is now on an uptrend, but on the other hand, it's not a rich country. There are lots of problems there. So that's, well, that's a question for... Anyway, I don't have a specific site or an app, but if anybody knows or if I hear about something, we'll share it all together. Okay. So I think we'll begin an early wrap-up of the show today, and then we'll do a preview for next week's events. Next week's events are also quite interesting, if not fascinating. And of course, you can still have time for more questions. Okay, before that, we have a question from Fabian. All considered, what's your bias in euro dollar today and why? I think we could have... My bias is that we'll have a weaker euro dollar on the inflation figures in Europe. I think they will be not convincing enough. They'll come maybe as expected, but not good enough, or perhaps they'll be a small miss, and that could hurt the euro, implying more ECB action. But then we'll have another disappointment from the US GDP figures, and that could strengthen the euro as a safe haven. So I believe you might see a fall and then a rise, but that's really not a trading advice and just my hunch. Okay, so I expect global disappointment. I see that today I'm negative. I see the glass half empty, if you wish. Anyway, currently, let's talk just about levels. Currently around 109. Very messy here. I think maybe this line is obsolete. 110 remains the key resistance line, then 110.70. On the downside, clear support at 107.80 and 107.10. We could have a much more narrow range, not 107.80 and 110, but hugging the 109 level, hugging the current level. Okay. All right. Let's just take here another look. Also, one of my favorite. This is the CME Group chart. Look, it has worsened. The implied probability of rate hike in the United States is basically nothing in March. Chances are under 15%, under 16%. The next time markets expect a rate hike, not in April, not in June, not even in July. Maybe low chance in September, okay? And for sure, well, nothing is sure in November. So by the end of the year, the rate is expected to be maybe 1%, maybe 2 more hikes on a very optimistic forecast, more like just 1 rate hike later in the year, okay? Another question here. My money is next rate hike in September. Some say that the next move by the Fed will be a rate cut if the US economy enters a recession. But of course, you never know. Lots of options over there. Okay, so this is the wrap up for the live market open for Friday, the end of the month, January 29th. We had lots and lots of action. We'll do the wrap up for today and then preview for next week's events. Let's begin from what we had early in the morning. boom, the Bank of Japan went negative deposit rates in Japan, excessive rates, minus 0.1 on excessive money parked with the Bank of Japan in 3 tiers. It was a very, very, very close call. 5 members, including Governor Kuroda, voted for the move, 4 voted against the move. Very tight decision. And they also maintained their QE program and pushed back inflation expectations. The the Japanese yen certainly reacted. This wasn't fully priced in. Some had expected more QE. Some kind of action was in the cards, but not this strong. Very significant move from dollar yen, moved all the way to 121.40. I see resistance at 121.50. Support, I would say only 120. Currently stable in range 120.75. Japan basically joins the currency wars against China, against the US, against Europe, against everybody. A weaker yen. They also can afford a weaker yen because of oil prices, which are low despite the recent move higher. Okay, what did we have yesterday? German inflation came out as expected, but today's Spanish inflation missed. Okay, this is important for what we have later today. UK GDP came out as expected, 0.5. After this long list of bad news from the UK, the no news, as expected news was positive for the UK. In the United States, we had a terrible release. The durables goods orders, a drop of over 5% in headline, over 1% in core. It hurt the US dollar. It lowered expectations for the GDP figure that we have today. And this morning, we had German retail sales disappoint. Let's look at a few more charts before the events of today. Euro dollar had a nice move on weak US data and and what we had yesterday in oil prices, all the way here to 109.65, and then we're back to the previous range. All eyes are on the GDP, on the Eurozone inflation figures. We have at 10 GMT, we have a small warm-up with the monetary data, but what's important is the Eurozone inflation data. We're expecting a small rise because of the removal of base effects to 0.4. Also watch out for core inflation, okay? Before we talk about US GDP, in the wrap, I didn't talk about what we had yesterday with oil. We had rumors of a grand cooperation, global cooperation to cut production, lift prices. We had a rally of nearly 10%, almost to 34, 80, 30, almost to 35. So we had this short squeeze, as Dale mentioned, but since then we had things stabilize, fall back down. Iran is not in, Russia is not certain, things like that. So we have a renewed rise in oil prices, but it's it's looked like the short squeeze. Dollar CAD had a very exciting day yesterday, fell below 140, and then managed to recover dollar CAD, but I would say we have support here at 139.50, resistance 140.50 and 141.70. Today we also have Canadian GDP, which is expected to be okay, which is expected to show a rise of 0.3 in November. Okay. What else do we have today on the agenda? Main event, main dish for today, US GDP. After the weak durables goods orders, we're expecting very low levels. Some expect a negative number. We can't rule anything out. I think the Fed hinted that we have slow growth on maybe almost nothing, but positive and not negative. 0.8 is expected. If we have a negative number, this could still talks about recession. 2 consecutive quarters of contraction is a recession. Probably very weak growth. Important to watch also the components. If it's built on inventories, growth is built on inventories and then it's negative, or if we have negative inventories and then there is some kind of silver lining. We also have good trade balance, employment cost index, and a few other peripheral figures of the GDP, but the headline GDP is the most important one. And last but not least, consumer sentiment. No big changes are expected, but it's worth watching because it's the last event of the week. Let's look at a few more charts. Pound dollar, better mood in markets, currently a bit higher, struggling with 143.65, resistance at 144. 80, support 142.40. Okay, nothing important from the UK today. Euro, the range, wide range, 107.80 to 110. Let's see how things develop with the euro. We talked about CAD, we talked about yen. Yeah, 121.15, 120 is the range. Aussie dollar moving higher. We had better figures from Australia and no bad news from China this week. Currently it's 17.96, 71.50 is resistance, support at 70.50 more or less. New Zealand dollar recovering from the after being hit by the dovish RBNZ. Currently it's 65, resistance 65.80, support 64.20, the post RBNZ level. Okay. So we're currently seeing stability in euro dollar, but hopefully this will not remain like this. So that's the wrap up for today. We'll move quickly to the preview, but I see a question or two. Comment from Fabian, negative US GDP means higher euro dollar, but also good GDP means higher euro dollar because of more probability of a rate hike. Yeah. Stock markets, yeah. Let's also see, as you said, like how stock markets react. Yeah, euro dollar is a complicated pair because of the safe haven flows. It can rise on bad news, it can rise on good news from the United States. I think that if we have a really, really good GDP figure, it'll weaken. If we have a bad one, it'll fall. If we have a mixed one, it all depends on stock markets. Perhaps other currencies are better to trade. Okay. What your needs from GDP, US GDP to go down? I guess a very, very strong number to show that the US economy is leading the world forward. And we might not have a rate hike, but we still have a strong US economy. Anyway, I expect the figure to be quite weak. And I see a better chance that euro dollar will rise on US GDP because I expect it to be weak, but you never know. Remember, we have also Eurozone inflation today. Okay. So this is the preview for next week, the first week of February. A new week is always exciting. The first event is important. Chinese PMI, we have the independent one and the Caixin one and the government one. The independent one is more important. Manufacturing PMI, we might see another negative number, another figure under 50 points, and that could create worries, could hit the Australian dollar. But if we have some kind of recovery, it could be, of course, positive. It's not only important for the Australian dollar, it also impacts oil prices, it also impacts the global mood. And it's the first release for the week. ISM manufacturing PMI on Monday, first hint towards the non-farm payrolls. It was negative, under 50 points in the past few months. It could be negative once again. Let's see how bad the US manufacturing sector is. Manufacturing all over the world doesn't look good. On Tuesday, we have rate decision from Australia. Given the recent CPI numbers, they're not expected to cut, but they might hint to further cuts later this year if things deteriorate. Expectations are now for a relatively upbeat move, but you never know. Also on Tuesday, we have, focus on the antipodian currencies. We have the employment report in New Zealand together with milk prices on the same day. Let's move to wider events. We have on Wednesday, we have the ADP non-farm payrolls. Recently, ADP NFP has been better correlated with the official government figures, so it's important. Last time we had an excellent ADP of 257,000, and it implied a strong, and eventually on Friday, we had an excellent official non-farm payroll, so let's see if it remains strong again. We also have another significant hint. We have the ISM non-manufacturing PMI, the services sector, which is doing much, much better, and it's much larger than the manufacturing sector in the United States and also in other developed economies. And this is the significant hint towards the non-farm payrolls. On Thursday, we have the UK rate decision. It's not the rate decision itself that matters. because no change is expected. We also have the meeting minutes and the voting pattern. If we still have 8 against 1, it's positive for the pound. But if we have a unanimous decision about it's not time to raise rates, then I expect, of course, a fall in the pound. And then Friday, last but not least, used to be king of Forex, maybe still is, but it's a bit losing its charm. And the non-farm payrolls in the US, I don't have expectations at this moment, but I expect it to be weaker than last month's super figure of 292,000. Remember, not only the jobs, but also the wages matter, okay? And then at the same time on Friday, we also have the Canadian jobs report for those of you trading Canada. But remember, the loonie moves more with oil prices more than anything else. Okay, so that's this week. The big event, I'll just mention it once again. The Fed decision that we had on Wednesday, it was slightly dovish. Growth slowed in late 2015. That's a hint for today. Inflation is still a big worry. They removed the reference to balanced risks, which I don't see as that important, but many analysts talked about that. They're monitoring global and financial developments. That means China and stock markets. And despite a new hawkish composition, they voted unanimously for a dovish decision. The expectations after this for a rate hike in March became lower. And after the bad figures yesterday, they became even lower. And let's see how GDP impacts expectations and impacts the dollar. The week and the month were exciting, and they both end with a bang. Okay, so I guess it's time to go. Thank you very much, everybody, for coming. Thanks for the great questions. Thanks for the participation. Do join us, Valeria, Dale, Mauricio, and I, if I'm not mistaken, at 1 GMT for coverage half an hour before the GDP release. Okay, should be an exciting close to the week. On Monday, I will not be here, taking a long weekend out of town, and I'll be back on Tuesday. But you'll have all the news available, and I guess that's it. So, yeah, thanks, Adinda, for the link. In any case, we'll have a recording on the site on FX Street and also on Forex Crunch of the full show today, the wrap-up, and the preview for next week, published probably today, and then you can see it also during the weekend, the preview for next week. So I guess that's it. Said everything there is to say. Just to wish everybody a safe and successful trading day, an excellent weekend, and see you next week on Tuesday. Okay, so don't worry, markets are open on Monday with the Chinese figures, but I will personally not be with you, but I'll be back on Tuesday. Okay, so have a great day, weekend, and see you next week. Ciao. Bye-bye.